By now, you have followed a loan from its earliest stages, understanding the anatomy of mortgage lending, submitting and underwriting an application, and qualifying the borrower. In this section, you bring all of that work to its destination, closing the loan and closing the real estate transaction so that ownership actually changes hands. At the same time, you will expand your understanding into the world of commercial and business finance, learning how different loan products, ratios, and terms show up in real estate deals, especially for investors and business owners. As a real estate professional, you are often the bridge between the abstract idea of loan approval and the very concrete reality of funded, recorded, and keys delivered. Understanding how money actually moves at closing, what prepaids and title fees really are, and how more advanced financing tools such as SBA loans, commercial credit lines, and prepayment penalties work will make you far more effective with both owner-occupants and investors. From loan approval to funding, what closing a loan really means. Closing of a mortgage loan or trust deed normally happens at the same time as the real estate closing. Even though everyone casually says, "We close on Friday," different parties define closing slightly differently. For the lender, closing is when it has funded the loan. The lender wires the approved loan amount to the escrow or title company, following detailed written instructions that specify how those funds may be dispersed. For the escrow or title company, closing is when the parties sign all required documents and all conditions to disbursement and recording have been met. For the buyer and seller, closing feels real when the deed is recorded and the buyer finally becomes the owner of record. At the settlement table or signing appointment, the borrower must bring the funds needed to close. In modern practice, this is done either by a wire transfer from the borrower's bank or by delivering a cashier's check drawn on a recognized financial institution. A personal check is rarely acceptable on the day of closing because it must clear the banking system before the escrow company can safely rely on it. If a buyer insists on using a personal check, it typically needs to be deposited with escrow well in advance, often up to 10 days before the scheduled closing, so that the funds have time to clear and be available. Once all funds are in, the escrow or title officer coordinates the final steps. The buyers and sellers sign the deed, loan documents, closing disclosures, and any association or addendum paperwork. A notary is present to verify identities and notarize documents that will be recorded, such as the deed and the deed of trust or mortgage. After signatures, the escrow officer confirms that all lender conditions are satisfied, disperses funds as instructed to pay off existing liens and loans, pays commissions and fees, and then submits the deed and loan instruments for recording. When the deed is recorded in the public records, ownership officially transfers, and the transaction is considered closed for the parties. Income underwriting ratio calculation, simplified. A formulas: 1. Conventional loans, monthly PITI equals 25% minus 28% times monthly gross income. For the example below, they use 28%. 2. FHA loans, monthly PITI equals 31% times monthly gross income. B. Examples. Borrower earns $2,000 per month gross income. Conventional example. PITI equals 28% times $2,000 equals $560. FHA example. PITI equals 31% times $2,000 equals $620. Problem 20, broken down clearly. Borrower information. Monthly income, $4,000. Monthly debt payments, $600. This part does not affect the front-end ratio calculation. We only use income. Ratios required: conventional lender, 26%. FHA lender, 31%. Step-by-step math. Conventional, 26% times $4,000 equals $1,040 FHA. 31% times $4,000 equals $1,240. Final answer: conventional. $1,040 FHA, $1,240. Problem 21. Debt ratio calculation, back-end ratio. A borrower earns $4,000 per month and has $600 per month in debt payments. What monthly housing payment can this borrower afford based on debt ratio? Typical ratios used. Conventional, 36% back-end ratio. FHA, 43% back-end ratio. Step-by-step, conventional, 4,000 times 36% equals 1,440. 1,440 minus 600 debt equals 840. PITI allowed FHA, 4,000 times 43% equals 1,720. 1,120 minus 600 debt equals 1,120 equals 1,120. PITI allowed. Final answers. Conventional, $840. FHA, $1,120. 5. Points A. Formula. 1 point equals 1%, or 1 of the loan amount. Example. A lender charges 3 points on a $72,000 loan. 3 points equals 3 times. OIG a 1 times 72,000. 3 times 720 equals $2,160. Problem 22. A lender charges 2.75 points on a $240,000 loan. How much must the borrower pay? 2.75 times. Darnos 1 times 240,000. 2.75 times 2,400 equals $6,600. Escrow, title, prepaids, and closing costs. The money needed at closing is more than just the down payment. A buyer's cash to close usually includes closing costs and prepaids. Prepaids are certain expenses that must be paid in advance and deposited into escrow or paid up front. Common examples include an initial lump sum of property taxes, a year of homeowner's insurance, plus extra months to set up an escrow reserve, and sometimes prepayments of mortgage insurance or special assessments. For instance, a buyer might be required to prepay 14 months of homeowner's insurance and 4 months of taxes so that the lender's escrow account has enough cushion to pay the first bills when they come due. Escrow fees and title fees also appear on the settlement statement. Escrow fees compensate the title or escrow company for its services in coordinating the closing, handling funds, and preparing and recording documents. These are often split between buyer and seller according to local custom or contract negotiation. Title fees include the cost of title searches, title examinations, and title insurance policies. In many standard purchase contracts, the seller pays for an owner's title insurance policy that protects the buyer's ownership against covered title defects, while the buyer pays for the lender's title insurance policy that protects the lender's security interest in the property. Although practices vary by region, the underlying purpose is the same: to make sure that both owner and lender are protected if a previously unknown claim or defect appears later. Behind this system stands the American Land Title Association, or ALTA. ALTA is a national trade association representing the title insurance industry. Its members conduct title searches and examinations, handle closings, and issue title policies that protect real property owners and mortgage lenders against losses from defects in title. Understanding the role of ALTA reinforces why your clients receive thick title commitments and policy booklets at closing. They are part of the standardized framework that underpins title protection nationwide. Other costs and fees often appear as well. Real estate commissions are usually paid by the seller under the terms of the listing and purchase contracts. The buyer and seller may split the escrow fee for the settlement service. There may be charges for a home warranty, association fees such as HOA disclosure and transfer fees, prepaid association dues, courier and wire fees, and notary fees. The settlement statement itemizes all of these amounts so both sides can see who pays what. One important practical point for buyers is to appreciate that prepaids are not extra junk fees. They are necessary funding of expenses that will arise soon after closing. By prepaying them and placing them into escrow, the lender can be confident that taxes and insurance will be paid on time, which helps protect both the borrower and the lender's collateral. Closing from the real estate agent's perspective. For the real estate agent, closing is the moment when the deed is recorded and ownership changes hands. Until recording, the seller is still the legal owner, even if everyone has signed. Once the deed is recorded in the public records, the buyer becomes the new owner, and the transaction is considered fully closed. This is why agents often watch for confirmation from the title or escrow company that recording numbers have been received from the county recorder. Only then should keys be turned over and possession transferred according to the contract. As an agent, you can add value by preparing your clients for what happens at closing, explaining why they must bring a cashier's check or wire funds instead of a personal check, walking them through the major categories on the settlement statement, and clarifying who usually pays for owners' and lenders' title policies in your market. You can also help ensure that all contract contingencies, such as repairs and final walkthroughs, are satisfied well before the signing appointment, so that closing is a smooth formality rather than a stressful scramble. Commercial financing options connected to real estate. Residential purchases use a relatively narrow set of loan types, but in commercial and business real estate, financing options are much broader. Many of your investor or business clients will use specialized loan products alongside or instead of traditional mortgages. Understanding the basic shape of these tools will help you speak intelligently with commercial buyers and recognize when a financing structure may affect timing, risk, or closing conditions. A common tool is the business credit line. Under a credit line agreement, a lender commits to make funds available up to a certain limit, and the business can draw on those funds to smooth temporary cash shortages, such as the gap between paying suppliers and collecting from customers. This is frequently used to finance inventories, receivables, or project-related work. Lines of credit are revolving. The business can borrow, repay, and borrow again, as long as it stays within the limit and meets the lender's terms. Short-term loans are another frequent option. These are used for seasonal buildups of inventory and receivables and are typically repaid in a lump sum at maturity, often within 1 year. They are usually secured by business assets and are not designed to be permanent capital, but rather to bridge predictable, short-lived needs. Asset-based loans take this idea further. In an asset-based loan, the lender advances funds based on a percentage of current assets, such as receivables or inventory. The lender takes a security interest in these assets, and the loan becomes a source of working capital. The more high-quality receivables or inventory the business has, the more it can borrow. Bridge loans, blanket loans, and other specialized structures. Real estate investors often rely on short-term property, specific tools such as bridge loans. A commercial real estate bridge loan is designed to bridge a short period between acquisition or renovation and permanent financing. It generally has higher interest rates than standard permanent loans, but lower than hard money, with terms up to a few years and relatively fast approval and funding. Borrowers usually need decent credit and must provide a down payment, often in the range of 10 to 20%. Short-term investors, like flippers or renovators, use bridge loans to acquire and improve properties that they will later sell or refinance. Blanket loans allow businesses or investors to finance multiple properties under one mortgage. Instead of holding 10 separate loans for 10 properties, a borrower may place them under one blanket loan. A key feature of a well-structured blanket loan is the ability to sell individual properties without triggering default on the remaining ones, often through a partial release provision. The convenience and flexibility come with trade-offs. Blanket loans can be complex, difficult to qualify for, and may carry large payments or significant default penalties. Contract financing is another method in which funds are advanced as work is performed under a contract, and payments from the contracting party go directly to the lender. This approach is common in construction, government contracts, or other project-based businesses. Factoring takes a different tack. In factoring, a business sells its receivables to a factor, who becomes the new party entitled to collect from the customers. The factor pays the business a discounted amount upfront and then takes on the collection, risk, and responsibility. Factoring can provide quick cash for firms that cannot obtain traditional bank financing, but the cost is usually higher than other short-term financing. Term loans are traditional medium and long-term loans used to finance permanent working capital, new equipment, buildings, expansions, refinancing, or acquisitions. Commercial banks are a primary source. The term of the loan is matched to the useful life of the asset, and lenders focus heavily on projected profit and cash flow to ensure the business can support the payments. Equipment and real estate loans are term loans fully secured by the assets being purchased. Banks may loan a percentage of the value of the equipment or property, with repayment scheduled over its expected life. Commercial and industrial real estate loans may cover up to a portion of the property's value, with repayment terms ranging from 10 to 20 years or more. Leasing is a financing alternative, especially for equipment. Instead of borrowing to buy, the business leases the asset from a bank or leasing company. The business must still qualify based on cash flow and credit, and the lease typically runs 3 to 5 years. At the end, the business may have options to purchase, renew, or return the asset.